got a failing, when you got someone in a debt crisis and the whole thing's failing, and it's likely to trigger complete financial chaos, why have anything in it? Just get the hell out. And the only way you get the hell out is to get out of credit and get into real money, which of course is gold. And that is the message that central banks around the world now understand. They may not admit it, but basically that's why most of the central banks, and okay, not the major ones aren't admitting to anything. They're just keeping very, very quiet. But all the Asian central banks and government funds and all these sort of hidden bits, they understand completely what's happening to the credibility of the dollar and all the other Western currencies. And so they're getting out.
In today's episode, Alasdair Macleod sees gold and silver as crucial hedges against the declining value of traditional currencies, particularly the US dollar. He argues that while recent price rises in these metals make headlines, they actually reflect a steady erosion in the purchasing power of fiat currencies driven by inflation and excessive debt. For Macleod, gold and silver hold intrinsic value that isn't dependent on government creditworthiness, making them safer assets in uncertain times. Macleod is especially concerned about the vast debt burden in the U.S., which he believes has trapped the economy in a cycle of needing ever more debt just to sustain growth. With little political will to address this, he sees traditional fiat investments as increasingly risky, making precious metals more appealing as stable real money. He also highlights the efforts of BRICS nations to reduce dependence on the dollar, potentially even moving toward a gold-backed alternative. This shift, he suggests, could accelerate the dollar's decline and reshape the global financial system toward a multi-currency world. Looking ahead, Macleod anticipates that as demand for gold and silver grows, especially in the East, their prices could continue rising. He sees this moment as critical for investors to consider the enduring value of precious metals, viewing them as essential stores of wealth in a volatile economic landscape. Now we'll show you the best clips of the latest Macleod interview with As Good as Gold Australia. But first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
The new BRICS currency is not going to happen. Forget it. I mean, it really is. So I think we just dismiss all talk about it. If anything happens, it will be as a result of the collapse of our currencies, because our currencies are credit. As someone said before a congressional committee a long time ago, the dollar depends on the faith, if you like, that people have in it, the faith and the credit in the US government. So, when that collapses, then there may be a change. And I guess that the change will not be a new BRICS currency, but what it will be, I think, is for defensive reasons, China and Russia putting their currencies onto a gold standard. Now, whether they do it properly or not, we'll have to see at the time. I mean, it's very, very simple to do. So I think that's the important thing. Now, in terms of any comparison between the European Union and BRICS, the big difference is that the European Union is a political union, whereas BRICS is in effect a trade union. It's a union based on if you like, free trade between the members. That's the whole point of it. And principally, it's not just free trade, but also the recycling of investment to improve the infrastructure in these countries, to allow for the extradition of commodities and all the rest of it. I mean, for example, the building of a railway from Mombasa on the East African coast all the way through to the Congo is all about shipping out, sort of things like cobalt and copper and, all these wonderful things that are being discovered in the Congo. And in return, of course, the Chinese, are importing capital in. So the currency thing doesn't really matter in a sense. What they're doing is they're importing capital into places like Kenya, Uganda, Belgium, the old Belgian Congo, the Congo, Central African Republic, and so on. The idea basically being that by improving communications, by opening up the country properly, investing in it, then everybody's going to benefit, including China. The only country with a problem in this, I guess, really, is Russia, because Russia is a huge net exporter of energy in particular and other commodities, and does not have imports that match. So she is always having to import other currencies, which is the result, if you like, of her sales of energy in particular. So she's up to her neck in Indian rupees, for example. Now, that's not a very happy situation for Russia. And I think that's why Russia was actually quite keen to push the idea of a gold-backed BRICS trade settlement currency back in August last year, ahead of the Johannesburg summit. But that is now a dead duck. That's not going to happen. If, as I say, if anything happens, it will be as a result of the collapse of currencies in the West. I mean, the other thing, so to respond to your listener's question, or viewer's question, I mean, really what they're trying to do is they're trying to assemble a parallel world, if you like, to the West, so that instead of the IMF and the World Bank, you've got the new development bank, which will do similar functions. They're planning, and this was announced at Kazan, they're planning, new precious metals exchanges, wheat exchanges. They're looking at other commodity exchanges and all the rest of it. So the idea basically is to build a complete parallel structure so that they don't rely on Western capital markets to sell and acquire commodities and all the rest of it.
In today's news recap, silver short squeeze coming. The Federal Reserve cut interest rates for the first time in over 4 years in September, sending gold past a record-setting $2,500 an ounce. The aggressive half percentage point reduction was in response to the Fed's significant progress in bringing down inflation, as well as a slowing U.S. economy, evoking recession fears. Gold's rally, which started in mid-February, has been underpinned by increased geopolitical risks, the upcoming U.S. election, central bank buying, and slowing ETF sales. It last traded at $2,744 an ounce, up 37% so far in 2024. But silver has done even better, notching a year-to-date gain of 46%. Spot silver is now worth $33.67 as of Monday, 2030 New York time. Last Tuesday, it hit $34, the highest level since 2012. Silver has benefited mostly due to physical buying in India and China. So-called paper silver has also been a factor. In July, 2 months of outflows reversed to inflows. However, October has been the best month on record for gold ETFs, after silver struck a near 12-year peak on Monday, October. 21, Citi Research revised its 6 to 12-month forecast for silver prices upward to $40 per ounce from $38 per ounce. UBS Bank is also bullish on silver, with the caveat that the gold-silver ratio rose above 85 to 1 in September after hitting lows of around 73x in May. Despite this, we maintain our view that silver is set to benefit from a rising gold price environment, which is aligned with Fed policy easing. analysts at the bank said. Our expectation that the silver market will remain in deficit over the coming years implies continuous declines in above-ground inventories, which should help fundamentally underpin prices as well as act as a tailwind for investor interest. We see silver outperforming gold over 12 months, with the potential for its ratio to test the long-term average of just below 70x. The unexpected price surge has put 5 U.S. banks at risk of substantial losses due to their large silver short positions. A short squeeze refers to a situation where an individual or legal entity sells an asset in the future without owning it first in the hope of buying it back later at a lower price to make a profit. However, if the price of this asset increases instead of falling as expected, this individual or legal entity is forced to buy it quickly to honor the delivery of their forward sale. This hasty buying movement then contributes to accentuating the rise in prices. Now we'll show you more clips of the latest interview, but remember to smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Are expensive unless their values fall. It's really quite simple. Return, if you like, on your investment by one means or another. But equities, when you have a bull market in equities, inevitably it gets to a point where the bull market, if you like, is getting tired. The participants tend to be the wrong sort of participants. They are the general public who have just got back in onto equities because they have been rising. They don't understand why. They will buy something that has already risen, basically. At that stage of the credit cycle, bond yields are already rising. Now, what I have observed over the decades is that the first rise in bond yields tends not to upset the equity markets because the equity markets at that stage are being driven by momentum rather than value. However, when you get a pause, of course, then that momentum in equities continues and, it can very often translate into a bubble. But when bond yields start rising for the second time, that's the point where the equity markets really begin to fall. And we've had a rise in bond yields. I know it's only 60 basis points on the US Treasuries, 10-year Treasuries, long bond, whatever, since sort of mid-September. But I'm convinced that this rise is something that is going to continue. And the reason for that is because there is a debt trap which the US government faces. And I don't care which presidential candidate wins this election. They're both promised, if you like, to spend and increase the deficit, presumably before it will fall because the economy will recover or whatever dreams they may have about the future. But a rising deficit at this stage is going to be very, very difficult to fund, and it's going to mean rising bond yields. It's actually as simple as that. So this is the second iteration of rising bond yields. We've had the first, and the equity markets managed, if you like, to continue with their momentum through the first. Through the second, history repeats itself, or rhymes, however you like to put it. The second iteration of bond yields rising, that will upset equities. And I believe that the fall in equities actually could be very, very serious. Now, the reason I say that is that if you look at the valuation gap between bond yields and equities, they are actually standing at an all-time record, far higher, almost twice as high as they were during the dot-com bubble, which really means that the equity market is so far adrift from where it should be. It means that, if you like, there's a very high risk of a very, very sudden and nasty collapse. So this is something you've got to be aware of. And I think, if you like, putting it very, very simply, is part of my argument for getting out of credit. I mean, you think that equities give you protection against a little bit of inflation or whatever. I mean, well, sometimes yes, but sometimes it's extremely dangerous. I mean, I do remember in the inflationary times in the 1970s, stock markets performed extremely badly. So the idea that you get protection by being in equities in those times, and those times are back again, I would argue, it's completely fallacious.
What do you think of today's show? Do you agree with Macleod's insights on the potential shifts in global finance and the role of gold and silver as safe assets? Alasdair highlighted concerns around the dollar's stability, the rising influence of BRICS nations, and why precious metals might offer a crucial hedge against currency devaluation. Let us know your thoughts in the comments and check this video right here because it's a perfect fit for you. I'll see you on the other side.